the real value for any of these privately held businesses is often a function of how well they, as sellers of the business, are able to bring an engaged audience of credible buyers to the sort of bargaining table.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me today, I'm excited to have Peter Lehrman. Peter, how are you doing today?
Good to be with you, Todd. Thanks for having me on.
Yeah, I appreciate you joining me. And a little bit about Peter. He's the CEO and founder of Axial, an online platform that enables private companies and their trusted advisors to confidently raise capital, pursue acquisitions, and exit their businesses. Prior to Axial, Peter worked for the investment firm SFW Capital Partners, and before that at CLG, where he helped build the company's global technology platform for on-demand business expertise. And then you're in New York. You got your family there, and you know, hanging out there, and got this company. So let's talk about this company. Let's talk about your background and kind of your focus and what you're doing.
That sounds great. Should I jump in?
Absolutely.
All right. Well, so about 11 years ago, I finished graduate school, and it was in graduate school that I was working for SFW Capital Partners. They are a company they're an investment firm. They invest in privately held companies worth usually somewhere between $10 and $100 million in value. So businesses with usually anywhere between sort of, $5 and $50, $5 and $75 million in annual sales. And as part of my time working with them, I just realized how problematic it was for them to find business opportunities in the small sort of privately held corner of the economy. So just finding businesses that are for sale is a very hard, very time-intensive thing to do. And in the course of finding these businesses and searching for these businesses, I became just much more acquainted with the way these businesses are run and the way that the businesses are led and the issues associated with that make it much harder for these businesses to be sold when there's an opportunity for them to be sold, or when the owner or the family or the founders have decided that they want to exit the business. Usually these businesses have neglected a whole bunch of work associated with running the business. And it makes it very hard for the business to actually be sale ready. Even if they've got great products, great customers, lots of profitability, there's lots of other things that go into being sale ready. And so instead of, to make a long story short, instead of going and working full time at this investment firm, which is a great firm with great people, I decided to start Axial instead, hoping that Axial could be a platform that transformed the way small businesses prepare themselves for an exit, making sure that they've got the education they need, the tools they need, and ultimately the partners that they need in order to not just get an exit done, but hopefully get an exit done on their terms and at a price that's a fair and reasonable price. As opposed to what you hear about all the time, which is sort of, worst nightmare ever trying to sell your business. So I started the business about 11 years ago. We're based in New York City. I've got about 30 employees at the company on my team, and having a great time still, and really enjoying trying to change the way these businesses are financed and sold.
So the platform, companies can list their businesses for sale.
Yeah. So the way the platform works, it's actually interesting. I know that there's a lot of real estate operators and investors that listen into Pillars of Wealth. What we found, and what I knew before even starting the company, was that the listing model that is used for residential real estate and also for a lot of commercial real estate would probably be sort of DOA for privately held companies. And the reason is a tremendous amount of sensitivity to privacy. So when a family-owned business or a founder-owned business with a bunch of employees decides that they want to sell the company, it's just a highly sensitive decision. And so the listings design or the listings model that's used, we actually decided not to build the Axial platform with a listings framework. The way that it works is simple. Everything starts out completely private and confidential to the seller. And the seller goes into the platform and they upload a bunch of data and information on their business in total secrecy, total privacy. And as they add more and more data to their little private portal inside the platform, the Axial software platform begins to give them tools, data, and information on how attractive is their business, what's the likelihood that it could sell, who are the types of buyers who might be interested in buying the business, who are potential M&A advisors or brokers that they might want to consider hiring to help them with the transaction process. And they're getting all of this information. It's kind of like if you go to kayak.com, you're thinking about flying from New York to Los Angeles, you get a huge amount of information before before you're making any buying decision, right? You get to see which flights and which are nonstop and what do they cost. So we tried to sort of create this private little interface for the business owner that gives them all this information on who they might be able to sell to, how long it might take, and then they can decide whether or not they want to take the next step, right? Whether they want to begin engaging in conversations with any of those partners, and do it on a private one-to-one basis. So there's a little bit of a messaging tool inside the platform, and it allows you to send a private message, just like you would on LinkedIn or, other online platforms. You can send a private message to someone and say, hey, I'm working on the following transaction, interested in exploring it. It looks like your interest and your criteria is a fit and a match for the kind of business that I've been running. Here's some basic information and here's an NDA if you'd like to discuss further. So that's kind of how the process starts out. It's all driven by the seller, and the seller is able to decide when they want to invite a dialogue with potential partners to discuss the transaction.
Interesting.
And that basically just happens sort of over and over and over again. Yeah. Not only do business owners use the platform, but a lot of brokers and investment bankers also use the platform, and they use it on behalf of their clients. So just like brokers in the real estate market who represent properties that are for sale or for rent, there are brokers that represent businesses that are for sale, right, in the business for sale marketplace. And we have developed a lot of partnerships with a lot of these brokers who use our tools in order to better serve and meet the needs of their clients who have hired them to sell their business. So we work with the owners, but we also play nice with the brokers and the investment bankers and the intermediaries that are in the market.
Sure. No, that makes sense. With real estate, it's, fairly easy to value it. Appraise, we can comp it, we can, base it on financials. Well, how do you value different types of businesses? And I'm assuming there's different categories, like a technology business would sell for a different basis than maybe a manufacturing business. Is that correct? And
yeah,
how do you begin valuing these businesses as somebody that's looking into it? Quite frankly, I'm looking into would it make sense to buy some businesses, especially as we go through this kind of recession here that we're currently in.
Yeah. So, I don't know nearly as much about real estate valuation as I do about business valuation. The short answer is, it's, there's kind of two answers to the question regarding value. The academic answer to the value of a business is that, any business, the value of any business today is equal to the present value of all the profits that business is going to generate in the future, right? So if a business is going to generate $1 million in profit, after taxes this year, and it's going to generate $1 million next year and $1 million next year, and you just ran that out all the way in perpetuity, there's actually an academic equation that will give you an answer for what the value of that business is today, based upon some assumptions about riskiness and how predictable that cash flow is. The truth is that while that might be the academic answer, the real value for any of these privately held businesses is often a function of how well they, as sellers of the business, are able to bring an engaged audience of credible buyers to the sort of bargaining table. So if you, as a seller of a business, let's say the business has 10 million in sales and $1 million of pre-tax profit, and it's a manufacturing business, it's based in America, it's got decent, to good customers and a reasonable team of people managing the business. Typically, those businesses would sell for somewhere between 4 and 6 times the cash that the business is generating, typically.
So 4 to 6 million in this case.
Yeah, in that case, right? That's sort of a range for a sort of small, privately held manufacturing, profitable privately held manufacturing concern, sort of somewhere between probably 4 and 6 times a multiple of the firm's annual pre-tax profit. But there's a huge difference between selling your business for $4 million or $6 million. There's a huge difference. There's transformational difference, right? And so one of the things that actually really ultimately matters at the end of the day is, can these business owners assemble a credible, sufficiently well capitalized audience of buyers to compete to buy the business, right? When you sell, if you own stock in Apple or Google or 3M, every day the stock market opens and there's thousands and thousands of buyers that are willing to buy your stock at basically the same price that the market is trading at that day, right? So you have a ready and willing and deep pool of buyers ready to buy 100 shares of Google or 1,000 shares of Exxon. It's not like that when you're selling a privately held business, a small privately held concern. So one of the biggest drivers of valuation and valuation success for business owners is, do they have a plan by which to get a really meaningful number of credible buyers to the table, more or less all at the same time? And what you find is, and for those who are in the real estate business as well, if you're selling your house and it's been on the market for 60 days and someone comes along and says, how about $500,000, and your asking price is $600,000, you don't really have too much of a leg to stand on, right? You've got an offer. There's nothing else cooking. You kind of have to either sit and wait and maybe, never get another bite, or have to wait another 60 days or take it. If you can get just one more bid on that property at more or less the same time that the other buyer is offering you $500,000, you can start to really create a little bit of an auction dynamic and create some auction pressure. It's the same thing in the world of buying and selling privately held businesses. The difference between having one potential buyer at the table and 2 it's enormous. It's an enormous difference. To go from 2 to 3 is even better. And so what you see a lot of business owners and a lot of good professional advisors do is they really, before they sell their business, they really try and get their ducks in a row on this issue. Because the range of value for a business, while there's only one academic value for a business, the truth of the matter is that when you're selling a privately held business, the value of that business is what anybody's willing to pay for it at that point in time. And if you don't know how to gather that audience together, if you don't know how to make sure that audience is aware that your business is for sale, if you don't know how to put together a story as to why that's an attractive business for them to buy and to operate, it doesn't matter. It doesn't matter what the academic valuation of the business is. You don't have a ready list of bidders ready to transact with you in the market. So the process by which you sell is totally critical. And I'm sure that's true in professional real estate as well.
Yeah, yeah, absolutely. Creating that buzz around the business and creating some excitement. Same thing with the property. I mean, if you know, marketing it to rent or marketing it to sell, you've got to create a story. You've got to create some excitement. We raise private capital for our apartment buildings, and you're not going to raise any private capital if you don't create excitement or buzz around the property and around the story of what you're going to do with the property.
That's exactly right. I mean, I mentioned a $10 million manufacturing business, selling for 4 to 6 times, the profits of the business. On the completely other end of the spectrum, and I think most of your listeners are well aware of this brand. Instagram had 20 employees, not a red cent of revenue, and the business was bought by Facebook for $1 billion, right? And at the time, a bunch of people said, this is just totally crazy, right? Like, he's completely overpaying. It's the stupidest acquisition I could possibly imagine. The company has no revenue. It's got 20 employees. What's he thinking? Well, it turns out that sharing photos was one of the most mission critical activities that everybody did on Facebook, right? And Instagram was becoming the default photo sharing, sort of social media application on the internet. It had an incredible amount of mobile phone momentum. And fast forward, I don't know, 5-6 years, that is a huge revenue generating business for Facebook, right? It's in many ways the growth engine that's powering the top line of Facebook beyond just the core Facebook.com application. Yeah. And so that's what kind of connects, that's a perfect example of storytelling, right? And the ability for the acquirer to see a narrative in the future and say, okay, this isn't generating any revenue right now, but if I take all of my Facebook advertisers and I plug it into the Instagram machine, and this business continues to grow from 10 or 20 million users to hundreds of millions of users, all of that revenue in the future is today, in my estimation, worth roughly $1 billion today, right? And that's ultimately the calculation that that the brass at Facebook was making. And so what sometimes looks totally crazy on the surface, particularly in the world of technology and startup valuations, sometimes you fast forward 2, 3, 4, 5 years, and all of a sudden you realize how powerful the acquisition was, and frankly, what a bargain it was. Even though at the time, to the casual observer, it looked like the craziest valuation in history.
Right. I remember a lot of people talking how stupid that was. It didn't make, Instagram was losing money. Facebook decided to pay them that much. What'd you say, $1 billion? Around,
yeah, it was $1 billion. It was $1 billion even, if I'm not mistaken.
And it's just, it's wild to think, but by making that acquisition, they changed totally grew their business and acquired a platform that, look at it today.
Yeah, and I think, one of the other things that really drives the value of a business up is when an acquirer is anxious about what your business could do if they don't acquire it, right? So in that case, Mark Zuckerberg was probably really nervous that Instagram would unseat Facebook as the primary photo sharing application on the internet for social media, users, right? Yeah. And that would really that would wound Facebook very materially. So I think at the time, Facebook was probably worth like $100 billion. So for him to buy Instagram for 1% of the current value of Facebook, kind of like, kind of a drop in the ocean, and a very, very good way for him to protect against the risk that Instagram would one day, disrupt the Facebook empire. So that's another reason why acquirers will pay you in certain situations. They'll pay you a huge number. They're afraid that you're either going to be acquired by their number one competitor, or They're afraid that you could disrupt and unseat them if you gather a head of steam. And it's all those kinds of storytelling and narratives that are really, really mission critical to selling businesses, and that's where you can sort of completely defy the academic valuation framework and drive an incredible outcome for your business.
Yeah, yeah. Talk about disrupting the academic. I mean, that didn't sell for 4 to 6 times.
Yeah, exactly. Yeah,
Right.
yeah.
So somebody looking at buying businesses, for me, I'm personally looking at potentially doing it, looking at how do I vertically integrate, and that acquiring businesses might make a lot of sense. How can you grow your business? How can you just grow through acquiring? Why does that make a lot of sense versus just starting from scratch?
Yeah, well, the truth is that sometimes it does make a lot of sense, and so sometimes it makes no sense at all. I think some of the reasons why, if you have an existing business, right, an existing manufacturing business, or you have, let's just take a simple example, right? I mean, these are just easy anecdotes. They're oversimplified, but they're illustrative. Let's say you're Coca-Cola, and for 50 years you've been producing Coca-Cola and everybody loves it, and you have all of these relationships with all of these distributors and all these trucks and all of these bottlers, and you want to keep on growing Coca-Cola, and everybody's drinking 1 or 2 Cokes a day already, so you can't necessarily grow by getting people to have a third or a fourth Coca-Cola. But the beverage market has, bottled water is becoming more and more of a thing. People are drinking more and more and more bottled water. So you look at, the bottled water companies that are out there, and you say, okay, these are independent bottled water companies. They have none of Coca-Cola's distribution power. They have none of the relationships that we have in all these cities all around the country. Maybe it's a great bottler with good relationships in America, but it has no international distribution, right? For Coca-Cola, they can approach that business and they can say, we'll acquire you for, X amount of money, right? And once we've acquired you, we can take your brand and we can take your products and we can relatively easily integrate them into all of our pre-existing distribution. So you've been selling water all over America. You've got a great product. You've got a great brand. We will take it, international, and we can do it overnight versus you as an independent, bottled water brand, building out all that infrastructure, building out all that distribution, and kind of competing with us as you try and go abroad. So what that does is it gives Coca-Cola an ability to keep growing their top line through acquisition. Usually, if they make that acquisition, there's probably certain functions and certain expenses in the bottled water company that they no longer need to retain, right? So
Yep.
At Coca-Cola, they've got a finance department already, right? They've got an HR department already, right? They've got an IT department, right, that handles IT and email, and they've got somebody who handles facilities, right?
Yep.
So all of the expenses that independent, brand needed to carry in order to run a fully operational business, many of those expenses can be removed by Coca-Cola upon the integration of the acquisition. And that whole area, of that whole sort of set of categories, where you can either save money or where you can increase revenue, those are, referred to in the trade as synergies, either cost synergies or revenue synergies. And the idea is, that the whole is greater than the sum of its parts, right? The devil is always in the details on this stuff, Todd. I cannot tell you the number of, failed acquisitions that were based upon a whole bunch of synergies that ended up going wildly off the rails for either complicated reasons or the most simple and straightforward of reasons. But frankly, one of the reasons why acquisitions go off the rails the most is just the personalities in the room, just the culture, the personalities, the ego. You have a CEO of a, independent bottled water brand. It's a hot brand, and he or she's been, riding high, building the business. Now, all of a sudden, they're part of the Coca-Cola, empire. And, they don't want to listen. They misbehave. They want to run the show, Coca-Cola. And, they just didn't get those, they didn't cross those T's and dot those I's prior to the transaction. And all of a sudden you have just a whole bunch of sort of organizational dysfunction disrupting all of those opportunities. But those are the reasons why people make acquisitions, right? Is they see opportunities to streamline the cost structure and to extend the top line through customer growth or territory growth or geographic growth.
Does it make sense for somebody who doesn't have a business? Let's just say I wanted to buy a manufacturing business. I don't have a manufacturing business. Does it make sense for somebody like me that doesn't have a manufacturing business to go in and buy a manufacturing business? And if the answer is yes, then like what's the first even steps, like process? What do people want to be doing?
Yeah. So, I mean, I think, if you've never been around manufacturing in your life, odds are the answer is probably not. But I think, anybody who's had a career in some field, right, whether it's in manufacturing, right, they were a GM of a plant, or they were, they worked for a software company out of college, or, usually, your first 5 to 10 years of professional life give you exposure to some industry, right? Real estate, manufacturing, technology. And I think once you have that exposure to that, to that market and to the nuances of that specific niche within that market, the idea of potentially going out and finding a business to buy and to try and develop that business actually becomes a more reasonable idea, a more sensible idea. And there's a lot of ways to think about, sort of doing that. But one approach is, putting your own capital into the transaction in order to buy the business. Usually, if you're going to buy a business, you're going to finance the purchase of the business similarly to the way you would finance the purchase of a home. So you would put some equity in, but you would also need some debt, right? And so you can get the debt in, more or less one of two places. You can get it from either a bank or some type of bank, which provides the loan and which will collateralize the loan against some form of assets. And the other place where you can very often, when you're buying a small business, get the debt is actually from the seller, right? Which is called a seller note. In which the seller essentially extends financing and says, you'll pay me back according to the following schedule, and you'll only pay me X amount at closing. And so there's actually, interestingly, Todd, there's this whole breed of owner-operators and entrepreneurs that have started these vehicles called search funds, like searching for a business, called a search fund. And there's this group of search fund investors, which are in the business of giving search fund operators about $25,000 at a time. The search fund operator raises about $500,000 and searches for a business for about up to 2 years. And the investors who gave that sort of $25,000 increment up front then get essentially preferred ownership and rights of first refusal on the ultimate business that has been discovered for purchase. And the search fund operator then owns a very significant amount of equity upside and then begins to pay themselves either as the chairman or the incoming CEO of the business. And it's become, it kind of got pioneered actually at Stanford University in their business school program, the Stanford Business School. But now it's kind of happening all over the place. There's business school graduates doing it, and there are people that never went to business school, but that, have had 10, 15, 20 years, inside industries and inside businesses that are informally raising what effectively is a search fund, which is a modest amount of capital that finances your ability to search for a business over a 12 to 24 month period. And you hunt for businesses, and you can use platforms like Axial to hunt for businesses. There are other tools you can use. You can tap your local network. You can, go to the local, real estate brokers, the local wealth managers, lawyers, and try and figure out, are there any businesses that, where the owner of the business is looking to retire and wants to transition the business, and you can put yourself in a position to potentially become the the acquirer of the business. And some of these searches pan out and some of them don't. The most famous of all of these is a company called Assurian. Assurian is now like a huge provider of insurance to like washer dryer products and handsets and cell phones. You go on Amazon and you buy a piece of consumer electronics, you'll see an opportunity to buy like a 1 year or a 2 year warranty to ensure that consumer electronic.
Sure.
Usually that's this company Assurian. If you can believe it, you go look up Assurian, you'll see it was one of the first search fund opportunities out of Stanford. And I think the investors who invested in Assurian made like, 300, 400, 500 times their money. I mean, it's one of these just extraordinary stories. So, the idea of, sort of leaving the corporate grind and going and finding a business to buy and operate yourself is kind of becoming more and more, it's still on the fringes, but it's actually really becoming more and more of a bit more of a mainstream career path that a lot of, people in their late 20s, 30s, and 40s, and even beyond are exploring and considering seriously.
Yeah, well, and as entrepreneurship has become more and more popular, I feel like that type of stuff, whether it's a startup or buying an existing business, is becoming more and more popular, more accepted.
Yeah, and also the internet makes all this a lot easier because you can go on to Google right now and punch in search fund, and you'll start seeing a whole bunch of white papers and resources, and you can just sit there and print it all out. And if you've got if you're holding down a steady job, you just research this over 3 to 6 months, and you can just learn about it without having to jump in the deep end the next day. You can sort of take your time and get familiar with all of this because the internet has made so much of this information available to anybody who's got a computer or a mobile phone.
Yeah, crazy. So I got a couple last questions for you before we wrap up. A lot of good information so far. What's the biggest mistake you've made in your business and your journey here, and how have you learned from it?
Well, let's see. I think I'd have to say I made I raised some money, and I was in the process of raising some money in 2014 for Axial. The business was doing pretty nicely. Business was growing quite fast. And I decided I wanted to raise some outside capital for the business. And I think the big mistake that I made is a very straightforward, understandable mistake, but nonetheless totally unacceptable. My CFO and I just did not nail down exactly the right revenue recognition formula for the business. So one of the ways that Axial generates revenue is by collecting subscriptions from its customers who use Axial. We also allow our customers to pay a contingent fee instead of a subscription. But on the subscriptions, you need to be recognizing that revenue in an appropriate and accurate way. If you don't do that, you can either inflate or deflate your actual GAAP revenue, like the sort of generally accepted accounting principles associated with how do you recognize subscription-based revenue.
Yep.
And it was an honest mistake. We got the formulas wrong, and I think we presented that the business was going to generate 10 million in sales that year, and the business was probably only going to generate about 8 million or 8.5 million that year. And we got into a dialogue with a fantastic investor, a great investment firm, And as they started to dig into the financial models that we produced and, how we were recognizing the revenue, they said, guys, you're you're recognizing this revenue incorrectly. And, it's not a $10 million business this year. It's probably an $8.5 million business. And it ended up being an $8 million year for us. He was exactly right. At that point, we were already under a letter of intent, with exclusivity for him to do this diligence on the business. And he said, listen, I just, in light of, discovering this mistake, I don't think that we can proceed with, the transaction. And, if your business is generating a lot of profits, that's not necessarily the end of the world. But at the time, Axial was losing money. I was investing all of our revenue and more to try and build the business and build it more quickly and build and establish, just a really strong foundation. And so I really put the business at risk because, the deal broke and I only had, I think I only had like 90 days of runway left.
Sure.
Anyway, I mean, all's well that ends well. I was able to dust myself off. We rebuilt everything from scratch, rebuilt the financial models, got our T's crossed and our I's dotted, and I've never made the mistake again. But it was an embarrassing mistake. For me, it was a real black mark for me, a black eye for me. I felt embarrassed. I felt incompetent, and I was. It was a really incompetent mistake, and it cost me a deal, and it almost cost the life of the business. So one of the things we haven't talked a lot about, Todd, but one of the things that really will kill a deal is when an investor really digs in and begins to see significant, just, poor record keeping, inaccurate financial statements. And it doesn't matter whether they were done, honestly and innocently or not. It just kills the trust in the deal. It undermines all of its momentum. And so I think one of the things that I always try and preach when I speak with business owners and give, workshops is just, you have to invest some of your profits in your financial readiness, your bookkeeping, your record keeping. If you can get your businesses to withstand an annual audit, that's a great way to get a third-party audit of your firm. So we started auditing Axial immediately after that. So I definitely learned that mistake the hard way, licked my wounds, dusted myself off, and was able to turn things around. But that would have been a mistake I could have easily and would have preferred to have learned the easy way. And unfortunately, I didn't. So for those of your listeners that are still listening, I hope they I hope they take advantage of my mistake there. That was a big one.
Yeah, and you're right. I mean, I'm killing a deal because of that. I mean, the seller keeps sending these financial statements to us, and they contradict with each other. They don't match up. And so whether he's being honest and just making mistakes, or whether he's trying to pull something on us, I can't tell. But it's just a deal where I look at that and I just go, I can't continue to go forward with it. Nothing makes sense here. So knowing your financials and not even knowing them, but like you made just a couple small maybe mistakes with it, and it kind of blew that whole deal up. And I appreciate you being open and honest with us, because that's definitely a hard thing to tell everybody.
Yeah, I mean, at this point, I'm out of the woods on that one.
Right.
And so, I'm more than happy to just sort of pay it forward. I mean, it was really, really, it was a very tough period that I brought entirely on myself. And it was totally avoidable. And so I guess, with the benefit of hindsight, and given the fact that, I'm still alive, and I made my way out of the crisis, the least I can do is be honest about it and share in vivid detail, because I hopefully it scares some entrepreneurs in the right direction.
Yeah, absolutely. A couple last questions. What's a favorite book that you could pass on to our listeners?
I keep coming back to this book. It's called High Output Management. I will confess I'm maybe a little bit of like a business book junkie, but this book was written by Andy Grove, who was the first CEO of Intel, the Intel Corporation.
Yep.
And that's back when Intel was, small business, not some big, huge, giant Fortune 50 company. And Andy Grove just wrote this fantastic book, basically taking all of his expertise in manufacturing and semiconductor manufacturing, and talking about the way that your business and the way you manage your business is basically a factory, and how you manage it, how you think about quality, how you think about defects, how you think about throughput. It's just an incredible book for managers and for leaders. Andy Grove passed away a couple of years ago, but he was just an amazing leader and operator. There's no BS in this book. There's no silly, acronyms or anything like that. It's just a hard hitting book that you can open up, and you don't have to read it, front to back. And you can open it up and sort of tune yourself up anytime you need to, but it's just outstanding. I've bought a bunch of them for my team and give it to all my managers. I swear by it.
Cool. Awesome. How do you like to give back?
I've been doing a couple of things to give back. I mean, the biggest daily way that Axial gives back as a company is actually through a huge amount of free resources on the topic of entrepreneurship. And a huge amount of data that we make available for free to the market. So
Awesome.
A lot of people have told me over the years, you should take all of this data and all this content and all this expertise, and you should turn it into, a class or something that you charge for, or it should be something that, and we've just decided, what, in the end of the day, it can go further, it can reach more people. People all around the world can read this stuff if we don't put this stuff behind a form and charge people for it. So I think, I think one of the ways that I hope I've given back and we've given back is just to make a huge library of high quality content available for free to entrepreneurs and to business owners that are trying to learn how to grow their business through acquisition or trying to get ready for a successful exit. And then, I personally have been a huge animal lover, actually, since I was a kid. My mom was a huge animal person as well. And so I sort of got very close to animals, worked on a farm as a kid. So I'm just a huge, so I've begun to do a bunch of work, both donating time and money to a bunch of anti-poaching efforts.
Cool.
Which is obviously a long way from home if you're talking about anti-poaching in, in Africa with the elephants, which have just been getting destroyed and slaughtered. But there's actually a bunch of anti-poaching that, needs to happen here in America.
Yeah.
Either healthy hunting or better hunting. All of it's good. But, some of the poaching that gets done is something that I've tried to focus on. Right now, Todd, I mean, my whole company is trying to figure out how we can give back and how we can become just a better and more sensitive organization on these issues of race. We're, one of my colleagues and we've committed to run 100 miles in the month of June. And for every mile that we run, we're donating $10 to an organization called the Equal Justice Initiative. But we're really just trying to sort of figure out what is the right way to give back, and in a way that just reflects coronavirus, what happened with George Floyd. There's a lot of things to process and a lot of opportunities to give back, not just with money, but also with time. So I've done a few things in my past, but certainly encouraging my whole team right now, as well as spending some time myself, just trying to figure out what's the immediate way that that we can give back. What's the immediate way that we can carve out a half a day once a month and either protest peacefully or find a place to volunteer just find ways to connect with what's going on in America and try and be a source of positivity and healing and tolerance. And muddling my way through that alongside, I think, everybody else.
Yeah, there's a lot of needs out there right now, and anything you can do to give back and to try to make it make your mark on the world and make it a better place is powerful. So
totally agree. It's just an endless set of opportunities right now to help people that had their lives destroyed by coronavirus, that lost loved ones. Obviously everything that's going on in terms of racial injustice is now, right alongside coronavirus as, another American tragedy that needs time and money and love and a lot of focus from a lot of talented people. So I hope to be part of that, and I'm sure you feel the same way.
Yeah, definitely. Well, Peter, we got to wrap up. I want to thank you so much for coming on the show, for providing a ton of great content for us. How can our listeners get in touch with you, reach you, and learn more about what you got going on?
Well, the front door to the company is on the internet. It's just www.axial.net. That's AXIAL.net. And like I said just a minute ago, there's so much free content and tools and tips and calculators and stuff like that can help an entrepreneur get going, can help people look at this search fund investor model. So that's one place. And then I'm an open book. You can find me on LinkedIn very easily if you want to reach out to me directly. And I think on my LinkedIn page, I share my email address, but my email address is just peter@axial.net. So if anybody wants to reach out privately to discuss something that they feel more comfortable talking to someone about, as opposed to going online and filling out a form, that's fine too.
Awesome. Well, Peter, again, I really appreciate you joining us, and tons of value you're able to add, and you have a fantastic rest of the day.
Thanks for having me, Todd. This has been great. Appreciate it.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.